inputs. Let's bring in Ross Mayfield, investment strategist at Baird. Ross, thanks very much for coming on the show.
Thanks for having me.
So, according to the numbers you have, since World War II, when the market's up 10% in the first half, it's always invariably a good year for the markets.
Yeah, I mean, it is. There's momentum begets more momentum in the markets, right? All of the bullish signposts that we saw late last year, early this year, that momentum is really bullish over the intermediate term. And this is just another way to slice and dice that data, that when you have a good first half to the year, more often than not, you have a good second half. Election years are no outlier there. That would be the case for them as well. And so, if you use that as kind of your baseline and then adjust on the margins based on the economic outlook and everything that's going on, you feel pretty good about things. People get nervous at all-time highs, but that's not really a reason to be.
Talk to us about housing. There seems to be no doubt that high interest rates, or higher anyway than they were a few years ago, are slowing down housing.
Yeah, absolutely. The U.S. economy writ large has been really resilient in the face of higher interest rates, but that's primarily because the consumer has been really resilient in the face of higher interest rates. Housing, manufacturing, more rate-sensitive sectors have struggled. Housing in particular is really struggling because you have a dearth of supply. New builders don't want to build because it's expensive to. Existing homeowners don't want to sell because so many of them have low fixed rate mortgages locked in. And then you have a big millennial generation looking to buy, structural demand, plus the post-COVID boom in work from anywhere. And you just have this fundamental mismatch. So prices are at all-time highs, affordability crisis, and there's not really an end in sight until you get some reprieve on the rate side of things so that builders can come back to the table and so that you might get a little bit more inventory in the mix.
Would you avoid housing related stocks? We just looked at the former lumber liquidators apparently in trouble.
You know, it's interesting because you would think on surface, right? The sector is struggling at the economic level, so the stocks might be challenged as well. You know, for the home renovators, it's actually a little bit interesting because with those home price appreciations, with low fixed rate mortgages for existing homeowners, there's a lot of home equity out there. And a lot of times that home equity finds its way into renovations, into house projects. So I think that could actually be a bit of a structural tailwind here, not just for the next 6 months or so, but for years to come, because that's a lot of home equity that has the potential to be unlocked. People are aging in place, doing home projects. A lot of demand was pulled forward into COVID. So I think there's a bit of an unwind and right sizing of that. But I think it's a structural tailwind for the sector for a time to come.
What about travel? Even though consumers may be feeling pain from inflation, you reckon the signs are that people are still desperate to go on vacation? Yeah,
I mean, we're seeing an increasingly bifurcated consumer, right? So lower income consumers struggling more, rents are going up, cost of food and gas, all of the things we know about. Inflation is really hitting that group of consumers hard. On the flip side, as I mentioned, stock prices at all-time highs, home prices at all-time highs. Higher income individuals are still doing pretty well. Now they complain about inflation, but again, they're still willing to go out and spend on things like travel, concerts, all of the services activities that we've seen boom post-COVID. TSA checked through the most passengers it's ever checked through just last week. So there's clearly still a tailwind behind, travel, leisure, hospitality. We saw the ADP employment report today. That sector added a ton of employees when basically everyone else is kind of stagnant. So still seems to be a lot of enthusiasm for that area.
What about oil? Would you be an investor in crude-related stocks, energy producers right now?
I think it's tough right now. I mean, number one, a big part of the story for the energy stocks over the past couple of years had been improved shareholder friendliness and capital discipline. We're kind of seeing that go by the wayside. There's been a lot of M&A. Crude itself has kind of chopped around around in that 80 range for a while. There's enough demand to keep things elevated, but you've got a lot of non-OPEC supply coming to the market. I still think there's a bit of a downside risk to the global economy from here. China is doing its part only to an extent. So I would probably, I'm not ultra negative on energy stocks, but there are other places I like better than trying to time the oil market in those plays.
I like this quote from Peter Lynch, the former Fidelity money manager. He said, more people lost money waiting for corrections and anticipating corrections than in actual corrections. So what are you saying? Is that a buy the dips philosophy or just let the money ride?
For me, it's more, there's a million ways to be scared out of the market every single day. Most of the time, they're not good reasons to sell your stocks, and you would have been better off just staying invested and dealing with the occasional correction. In 2020, we saw trillions of dollars enter money market funds, and that was when they were yielding next to nothing, and missed one of the great bull market rallies of all time. In our wealth management world, we typically have long-term investors that we're working with, and we try to remind them that there's a lot of noise. It's a political year. There's geopolitical fears. But more often than not, you're better off just riding the wave, being tactical on the margins, but remaining invested for the long haul.